Think big, trade smart. This video is presented by Meitou Investing. Hello guys, welcome back to another Meitou video. I bet that most of you can probably recall this, that some people working all their lives but hardly can afford a down payment for a house. And some people working from 9 to 5 or even 9 to 9, 6 days a week, doing professional jobs in well-known companies with high salaries. But the harder they work, it's only their bosses that are becoming richer, not themselves. There are a lot of jobs in the economy that makes people think that from day one, they can already see their future in the next 10 or 20 years or so, about who you're going to be and how much money you can make, and etc. Too many people are working hard every day to make money, but in the end, the harder you try, the farther you get away from being rich. People who read financial books normally would say that because these people don't invest. It's true that the rich tend to accumulate wealth through investments. But as a financial YouTuber, most of the people I see every day are investors. Many of them are staring at the market every day, doing technical analysis, mining these 10 baggers day to day, and learning the high growth strategy to get rich quicker. They're working just as hard as any other people. However, there are many people who get high profits in the short term, but there are only a few who can really make a fortune. And for the rest of the majority, the harder they work, the bigger their losses. But what really caused all of this is the mindless efforts that are draining your intelligence and energy away. This tends to narrow your horizon and makes you forget how to really become rich. So for today's video, I'm going to talk about how you can break out of this cycle of working harder but becoming poor, so that even ordinary people can get on the road to financial freedom. So how can ordinary people get rich? Well, the author of a book that has a profound impact on me is Rich Dad, Poor Dad by Robert Kiyosaki, who gives the answer right away, which is don't work for the money, make the money work for you. Robert perfectly illustrates this point in the book with his two fathers with different experience of wealth. The poor dad had a high degree, a coveted job, and a steady income. However, he has been struggling with his bills all his life and has been saddled with debt. This in turn forced him to work harder and spend a lifetime trying to pay his debts and bills. This is a classic case of working for money. The rich dad, however, with only a low degree, didn't have a steady job, but he became one of the richest person in the region by generating cash flow from his various business and assets. He made money work for him by snowballing his assets. So you might find it interesting. The poor dad from the book is the most iconic figure of social elites that most people are trying to become. A university degree, an employee of a big corporation, a good salary, and etc. But how does someone like this get stuck in a cycle where you spend your whole life trying to pay off your bills and envy the wealthy people but don't work hard enough to get it? Well, the answer that Robert suggests is that no matter how hard poor people try, they can never become rich without the right mindset about wealth. Poor people work for money, and typically their income goes straight into debt and then into expenditure. Sometimes it can go directly from the income to expenditure. The rich, however, they tend to get their income into their assets, and then the cash flow from those assets will pay off for their future expenditures. This implies to a kind of delayed gratification. If you think about it, turning your income into an asset is one of the most important and critical steps to becoming rich. And this is something that the average people often ignore. And the key to this step is investment. So learning to invest, or more precisely, learning how to invest in the right way is the only way to become rich. So why do I dare to say that? Well, because objectively speaking, there really isn't a better way for the ordinary people to get rich other than investing. First of all, investing breaks the objective limits to how much you can make. If you don't invest, it's very difficult for you to make money by working hard. Income from investment is passive income, which is also what I call the after-sleep income. It means the income you earned while you're sleeping. And each of us has limited time and energy. You work all day long, but there's not much you can do. Time is very limited, and there's a fixed ceiling to your salary. However, passive income from investing is different. It's not limited by your time and energy. It can be accumulated 24 hours a day, 365 days a year without any limits. And second, the rate of the growth of investment income is much higher than the rate of growth of salary you can achieve. So think about it in your head. What kind of wage growth can the best workers achieve? A 5 to 10-fold increase in income over a lifetime? But by contrast, if you only invest in the SP 500, which is an 8% return per year, you can multiply your asset 22 times from the time you work at the age of 25 to the time when you retire at the age of 65, thanks to the compound interest. From this perspective, let's classify the two tracks to become rich: investment and work. If you put the same amount of time and efforts, the return on your investment will often be significantly higher than your job. And this is why the rich tend to prioritize their investment before their jobs. And third, investing is more suitable for the average people than any other potential means of becoming rich. There are more ways to get passive income other than investing. You can do the same thing by selling copyrights, starting your own business, and etc. However, these methods have high thresholds, which vary from person to person and are not suitable for everyone. But investing is different. There are many ways to invest. It's easy to get started, and anyone can easily get access to it, and you can always find the most suitable investment targets for you. For me personally, the most suitable investment for me is the US stocks. Historically, the US stocks has delivered the highest return of any types of assets since the Second World War. There's no assets in the markets that appeals to me more than the US stock markets. Not only can I get a decent return from the appreciation of my US equity assets, I can also get steady cash flow from the dividends and option strategies such as cover call and sell naked put. These are the objective reasons why we must learn how to invest, which is what Robert has repeatedly emphasized in Rich Dad and Poor Dad. But in my opinion, what motivated me more to learn investing was the subjective impacts that those investments had on me. I cannot accept the consequences of not investing. So let's put it this way. If you don't invest, you have no incentive to save. And if you don't save, you lose the last chance to get rich. People that don't invest tend to have a negative attitude toward money. They often think instead of controlling their spending desires and saving their money, they believe their hard-earned savings will be eaten away by inflation, so that they might as well just enjoy themselves now than later. And then they run out of money, and faced with the next month's loan and various bills, and finally had to continue work harder to make money. So then they fell into the poor dad's working harder but becoming poor cycle. This is mainly because they do not understand or have an intuitive impressions of what kind of difference that investing can make to their money. People who understand investments will clearly know that every dollar that is saved may be the money that you didn't spend among the tens of thousands to upgrade a luxury car, or the money they decided not to spend on an afternoon tea or coffee. And by investing this money, the future will reward you with several times or tens of times of the value that you have saved. It's this mentality of delayed gratification that truly makes a person rich. So you see, in real life, it's not like what a lot of the financial books have said, that you have to learn how to save first and then you learn how to invest later. But to me, that's kind of the opposite. In my opinion, learning how to invest is the foundation of everything you can do to become rich. And that needs to be done sooner rather than later. Why do I say that? There are several advantages to investing for young people, such as long investment time, strong risk resistance, and a great capacity of fault tolerance. Time is one of the most important factors in investing. If you start investing at the age of 20 and put $100 a month into the SP 500 index fund, which is growing at an 8% annual rate, you could have $800,000 at the age of 70 for only a cost of $60,000. But what if you started investing at the age of 40? So by the age of 70, you can make around $150,000 at a cost of $36,000. This shows the importance of early investment in our path to wealth. But that is only $100 a month. But what if you can save up more to invest? When that number grows exponentially, the increase in your wealth will be absolutely terrifying. So let's put it another way. The more objective of your earnings from investing early, and you decided to spend the money or leave it into your saving accounts, it means the more painful you will realize it later because you know you have lost all of that potential wealth. the investments that seem safe to us are often the most dangerous. In addition, young people often invest with small amount of capital and small potential absolute loss, which also makes young people able to afford more mistakes and gives them enough time to fix these mistakes. The rare bull market in 2020 has attracted a large wave of young and rookie investors, also known as the Robin Hooder. They tend to pursue short-term boom opportunities, and many of them did achieve very high returns, and they're full of confidence, and then take a full position in a big bull stock, add leverage, do options, and pursue various aggressive investment strategies. But they are unaware of these aggressive investments, which are often the ones that have performed the worst in the retrospect over the long term. The investing veterans who understand investments will simply smile at them and often silently wish them good luck. But that's not necessarily a bad thing. Like, who isn't trying to go after high profits and who doesn't want to be financially free sooner? When you tell something to those aggressive investors, they normally won't listen, especially if they made money. But it's best to try to make the mistakes when you're young, because it's too expensive to try again when you're middle-aged and you have a lot of capital. The smart investor must reflect on the lessons learned and find the most stable way to make money over the long term. Like what Warren Buffett once said, the stock market is the device for transferring money from the impatient to the patients. The sooner you can let go of your fickleness, the sooner you can take a solid first step towards financial freedom. So after discussing all of these things, what am I trying to get at? And why should the ordinary people learn how to invest? Investing isn't simply putting money into the stock market and looking for opportunities that will make you rich. When it comes to investing, your first job isn't to invest, but instead to do well in your daily job. And you have not to only be good, but really good at your job. From one hand, you need a steady income from your job to provide capital to invest. On the other hand, and more importantly, it's only after you have mastered one thing so that you can understand that you can't do anything well overnight. And your successful experience on the job can often help you to invest. Of course, being successful at work is not enough. The poor dad from the book was an elite and Stanford graduate. However, he didn't lead to a rich life and only left with a pile of debt when he died. This is because he ignored the importance of investment. The second step in learning to invest is to build the right financial intelligence. The world is full of people who have high IQ or EQ, but very few have a high financial intelligence, which is why most people don't actually accumulate wealth. So financial intelligence is too general as a term. And to be more specific, I have broken it in the following 3 points. Number 1, as mentioned above, you should pursue to make money working for you. This means you need to learn to save and then to be careful not to let your money sit in your saving account or spend it too quickly. Instead, you should try to find good assets to invest in. Number 2, learn some basic financial knowledge and learn how to read financial statements. The purpose of reading financial statements is not to make investment decisions, but to deepen your understanding of the business logic of a company. And that understanding often determines whether or not you can make a good investment. Number 3, take time to pay attention to the market and look for familiar territory in the process. You don't need to be a finance major or have a background in finance to invest. As an average person, we should also understand some basic market trends, which is very helpful for your investment in life. And after armed with the right financial intelligence, you need to be willing to take risks when it comes to actual investing. Investing isn't about saving your whole life and buying an investment house in the perfect location. Poor people always like to invest in low-risk assets. They can never lose much, but they can never become rich. The investments of the rich do not always make money, but they can accumulate wealth for the rich. The poor people think that risk is a bad thing and must be avoided, while the rich people can see the opportunity from risk. They do avoid risk at some points, however, they will not resist absolute risk. Rather, they make investment decisions in terms of the comparison of return and risk. As mentioned above, young people are not afraid of making mistakes and have plenty of time to correct them. In investing too, don't worry about too much about losing, because every failure you make is a learning experience. And by learning from your mistakes, it's really the beginning of you becoming rich. If you like my videos, please click the subscribe button. Your supports are much appreciated.